Why does the United States pay higher drug prices than other countries? Because America's the only country in the world where 340B hospitals mark up drug prices and PBM middlemen charge billions in hidden fees. Meanwhile, Americans subsidize the research and development for new cures. Other countries benefit, but don't pay their fair share. Crack down on the middlemen. End the free riding. Lower drug prices. Go to balancethescales.org to learn more. Paid for by Pharma.
Reality radio for a really great future. We're talking real money.
All right, let's get all the preliminary stuff out of the way right here at the beginning of the program. All right, first, the phone number. You want to call us? We like it when you do that. Call us. Ask us questions. We like answering questions. We'll do all that stuff. All you have to do is pick up your phone. You got to pick up that phone, that iPhone, that Android phone. Do you have a landline? I don't think so. Maybe. Call us, 855-935-TALK, 855. Oh, I should say it this way. Call us at 855-935-TALK, 855-935-8255. We'll try to make money make more sense for you. Now, before we get started, I'm Don. That's Tom, by the way. Say hi, Tom.
Hey. Hi, Tom.
Hi. Yesterday, and some days, when I'm working on the podcast and it's all recorded, I'm just doing the paperwork part, I put a little music on in my headphones, and I have kind of an eclectic taste.
Eclectic?
Yeah. Well, but a lot of it was formed in my formulative years in the 70s. So I pop on the Who's album, Who's Next.
Oh.
And what plays in my ears? But they call that a bargain. The best I ever had.
Great song.
And it's funny because the topic of today's show, of this hour of the show, is this gigantic bargain in the stock market. That's what we're talking about today on Talking Real Money. What is the bargain? Maybe the best you've ever had?
The best, certainly the best in recent memory. And I would not call stocks in general a bargain right now. International stocks and these guys, the smaller stocks and value stocks. Fascinating. Since the beginning of 2014, that's a little over 10 years ago, the Standard & Poor's 500 has grown at an average annual rate of 13.2% a year. That's a huge run up. That's
the S&P
massive.
500.
Yeah.
That's the big company.
Yep.
Yeah. All right.
And on the other hand, as they say, the 2000, the Russell 2000 index of small stocks has gained just 7.2%. By the way,
wow.
I looked
That's
up
like half.
I looked up small value stocks just to get 7.2%. Yeah. Not too good. And what happens after the one part does better than the other? Well, you investors, not supposed to use messages, but I'm going to have pulled out $12 billion out of ETFs that invest in small stocks. Meanwhile, we've thrown $150 billion at ones that track large.
Isn't that backward?
People do chase performance. I get that. Sure. It's fascinating, though, how big is now.
That is a huge difference. And here's the problem. If we have one segment of the market that has returned more than it traditionally has historically over, say, 100 years, and you have another part of the market that is returning substantially less than it has historically, and we're talking more than 50% less than its historic return, then you have an imbalance. And eventually, there's this whole concept called reversion to the mean, where the money, it may take a while. That's where momentum comes into play. Momentum kind of keeps the big things going for a while. But it is likely, because it's happened in the past, that there will be a reversion back to these small stocks, and they will get back to something closer to their historic norms.
And you've seen that in international stocks so far this year, right? Because the U.S. market has outperformed other countries. Another part that plays into all this, Don, is how big is. That's why I started to say the five biggest companies in the S&P 500, they're 5 times larger than the combined value of the Russell 2000. Let me say that another way.
Wait a minute. Five stocks
are
worth more
times
than those 2,000.
Yeah, five times more.
5 times more. So we're talking about the Nvidia, which is like the value now of a medium-sized country.
Country, sure.
Apple, Meta, Microsoft,
I don't know, is it
Alphabet,
Amazon?
I don't know. They switch places all the time. But what does that tell you as an investor? That tells you you're doing something that is probably going to bite you in the behind before too terribly long.
And most people that I talk to one-on-one are overcommitted to large companies, overcommitted to the U.S. market, and overcommitted to growth companies because those have been the best place. And again, if you go back, way back, 100 years, that's even longer than you and I have been doing the show. I looked it up.
Yeah.
Large growth stocks have underperformed annually small cap value stocks by somewhere around 4% a year going back 100 years.
Right.
Not saying that's going to happen tomorrow,
exactly.
But wow.
Even if that's not the norm, it makes sense that small company stocks would have to return more over time to justify their higher level of risk. Now, Jason Zweig, who wrote this, isn't saying go out and buy a bunch of small company stocks and get rid of all your other stuff. So we're going to talk about what you should do after this.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
We love answering your questions on Talking Real Money. I'm Don McDonald along with Tom Cock. Give us a call at 855-935-TALK, 855-935-8255. Now, those who study the markets for a living, who have been doing it for many, 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 many decades, have discovered a few things about the U.S., well, the global equity markets. And one of those things is that over time, and we're not talking about a year or 5 or 10 or even 20, but over long periods of time, smaller company stocks have outperformed larger company stocks, and value-oriented, undervalued companies have outperformed those that have been posting rapidly growing earnings. Now, that isn't always the case, and right now we're in one of those periods where growth is winning and large is walloping small. But that is not always the case. The small in value, as we mentioned, are doing a lot worse than the large in growth. But what do you do about it?
Well, what you do about it is what you do about it all the time. You don't do anything about today because today, who knows what tomorrow may bring. What you do is you look way back. You build the right portfolio for you in terms of the stock to bond ratio first, right? How much risk you're going to take. Then you build the stock portfolio. It does not matter that technology makes up 35% of the S&P today. It does not matter that large companies have roared off to this huge return compared to small. You're still going to own all of these asset classes because the next date that might turn on the clock could be, let's just say 2000, 2001, for example. We're going to a decade where large companies actually lost money, but small made money, international made money. We don't know what's ahead. So we're not making a bet on what's happened lately. They're not even making a bet over the fact that large companies are way more expensive when you compare earnings ratios, those kind of things. What you're really doing is just saying, I want to own all these things. I want to have some of my money in all of those places.
But I want to overweight those a little, not a lot. In fact, even in his article, Jason Zweig says toward the end, you shouldn't be dumping large companies and putting all your money into small ones. But he says keeping 5 to 10% of your portfolio in smaller companies is a good idea. We think it could be even larger than that because there's an interesting fact that he mentioned in his column, and I went back to verify it. I'd never doubt him, but I verified it anyway because I verify now. The worst period for small cap, the worst single year for small cap stocks was actually better than the worst year for large company stocks.
I don't even know when that was.
2008.
30s? Oh,
2008.
Okay, yeah, all right, fair enough.
The Russell 2000 lost 34%, and the S&P 500 was closer to 40-something.
Let's not do that again. What do you say?
So having this kind of diversification serves a number of important safety purposes. Now, is it always going to be the way you make the most money? No.
No, and nobody knows that. Here's a simple way I think. When I look at 401k plans, people send me their stuff. I often, after you've decided on how much in stocks and how much in bonds, I pretty much take the large U.S., small U.S., and international and put a third in each one.
For the equity portion of your portfolio.
For the equity, that's what I'm saying.
I'm sorry, I was wrong on the S&P 500. Though in that 2008 downturn, it was 37 for the S&P 500. I was thinking larger 50. Cap. Yeah, it was.
I think from top to bottom.
Top to bottom.
It might have been.
Yeah,
50,
top to bottom, it was 57. 57 from
that's
top to bottom.
So, but I mean, again, you can do it relatively simply. I mean, the challenge you then run into is how much in those value stocks you mentioned, that made Warren Buffett a lot of money, how much in the growth stocks that have been on such a roaring run here lately. It gets a little more complicated, but a kind of just a simple 1/3 probably gets you to where you want to be.
And
pretty
that
easily.
takes all the guesswork out of this. Because if you are trying to be in the best place at the right time, you're just guessing.
Yeah, you're not going to be able to do that.
Don't delude yourself into thinking you're better, you're smarter, you're more prescient than the market, because you're not. I hate to break it to you, but
that hurts.
You're not. You're not.
Yeah, okay.
855-935-TALK. That is the number you need to use to call us on the show to ask your questions so we can get you answers, so we can help you become a better investor or spender or saver or college funder or whatever it is you're trying to become. 855-935-TALK. Let's go to Baltimore, Maryland. Eugene, welcome to the show.
Thank you. I called last week. I said I'd call back this week.
Oh, yeah.
Let me describe it in round numbers, my situation, and why I'm calling. I did my taxes this year, and I made the most money I've ever made in my life.
Congratulations.
Yay. That's awesome. Celebrate.
However, I've retired. Neither one of my wife or I get a pension. We have roughly $50,000 of Social Security coming in. And other than dividends and interest, that's it. But yet my taxable income last year was $400,000.
This is all generated off your portfolio? Is that what I'm hearing, other than the $50K in Social Security? Wow.
Yes. Now,
was that
RMDs? I missed something over the years? Or do I just have to be happy that I'm making the money?
No, you should be more tax efficient. No, that's too much. I mean, I don't know how big's your portfolio.
You don't know whether it's too much or not without looking at the portfolio.
Well, how much money's in your portfolio? Do you want to share that?
Yeah, sure. I'll round it off. We have, between my wife and I, we have $1.5 million in IRAs.
Okay. Yeah.
And we're both having to take the RMDs.
Okay, so part of that was the RMDs. Got it.
Mm-hmm. We have about $1.5 million in various forms of cash, most of it CDs and U.S. Treasury money markets and stuff like that.
I can already see a place to fix, but go ahead.
Yeah, that's one. Keep going.
3.5 million, almost all of it in traditional mutual funds.
Yeah, when you say traditional,
that's where
those are in a brokerage account.
Yeah, like taxable brokerage type account exposed to the taxation. Yeah, there's some things you could do. First of all, in the cash, with that much income, it might make sense to look at municipal bond fund that would eliminate most of the taxation you're paying on the cash. That'd be easy. Then the money in the taxable account, there's likely some things that you could own that would make for far less taxation. And you should consider that. You should get somebody to look at that and say, what could I do? Now, the challenge you face if you have big gains in those, you want to sell that for more tax, et cetera, et cetera. But that should be examined carefully because, yep, at the, what were your RMDs?
Really big.
How much?
What were they?
How much?
much?
Were they? Yeah.
Between the two of us, last year was around 110,000.
Okay, there's a huge leak somewhere. There is a
that's pretty
huge
hefty.
leak because that means you've got $290,000 in taxable gains or income coming from somewhere else. A big chunk
he has
of
a
that.
Social Security 50 plus the 110.
Yeah.
Well, what it is,
100 and so on.
what
But
it is
it's coming
is
from that 1.5 in cash in large part.
What it is, most of my investments have been where they are. One of them is T. Rowe Price. For years, like 25, 30 years, and even before ETFs were thought of. So I don't hardly own any ETFs. And the problem is, I'll give you an example. One of my funds with them, one of the health science funds, I have a net value of about 400,000.
Hang on, we got to take a break at this point. Hold on just a minute with us, Eugene. We're going to take a quick break. Come right back to you after just a minute. Don't go away. 855-935-TALK, the number.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
See, that wasn't long at all. It was a really fast break.
Piece of cake.
Hi.
Right back.
Welcome back to Talking Real Money. Don McDonald here with Tom Cock and Eugene in Baltimore, who has a great portfolio. I mean, not great, but he has a big portfolio, a lot of money in it. We don't know if it's great or not. We think it needs some work, but he was explaining why he has so many gains. And one of the reasons why he has a lot of gains is because he's got old funds from the good old days that he's been in for such a long time. They have done what funds are supposed to do. They've appreciated like crazy. And they distribute income and capital gains. And if
they don't care, their business is not to save you taxes.
Yeah.
Nope, they don't care. But here's a couple suggestions. Number one, I would have a fee-only 100% fiduciary review it just to see what could be done.
Oh,
That's
my
one.
gosh, yes.
Number two is you mentioned T. Rowe Price and others. I think most of these traditional mutual funds are going to become exchange traded funds with no tax hit. This is all kind of happening right now in the background. Some of this has happened already.
I don't know if T. Rowe's doing it.
I don't know about T. Rowe, but I would be having the person who did the review tell them, look, will you find out for me? Because you may not have to sell anything and you may get the reduction. Now, exchange traded funds would be far more efficient, especially in a $3.5 million portfolio.
That's a suggestion that I was thinking about.
Yep.
I didn't know maybe existed. In other words, is there a chance I could call T. Rowe Price, where the bulk of the traditional stuff is in mutual funds, and say, do I actually have to sell fund XYZ to buy this exchange-traded fund, or can I just swap it out without actually having a capital gain? And because one of the funds I have with them, $400,000 in value, $200,000 basis.
Yeah,
so if I sell that,
the way it will work.
We don't want you to do that.
The way it will work is if they have, and I don't know that they have. This is not we don't talk about T. Rowe Price a lot because they're actively managed funds. But if they have an ETF that is the exact duplicate of your mutual fund, then the new rules now may not be happening until next year. It's just beginning. Yep. But under some new rules, they should be able to move that money into the exact same ETF. In essence, that ETF just takes your shares and adds them to the pool. So that is absolutely something you should call and talk to them about. See if it's in the works. It may not be happening yet, but find out if it's in the works.
And this has happened before with Dimensional and with Vanguard and maybe others too, where they have managed to do this with no tax hit. Sorry, Eugene, go ahead.
Is there a name for this that I can mention to them? Or do I have to kind of explain it out?
Wow, is it recharacterization?
No,
it's exchange traded fund takeover. That's a good question, Eugene. I'm not sure I know the name.
Tax-free movement from one fund to another.
If you would probably have to get the right person there. That's why I worry about having you call T. Rowe Price.
It's called mutual. It's called a mutual fund to ETF conversion, Eugene.
Mutual fund to ETF conversion. Yeah.
Good. I'm glad I called you guys.
No, thank you.
We had the answer.
And really, really, really seriously, who is your broker? Who's your broker?
Well,
for most
custodian.
I have
your
a
custodian.
fairly large account with Raymond James.
Yeah, you don't want them. Get rid of them. Who else do you have?
But none of the stuff I've had issues with is with them.
Okay. Well, but what?
And the,
No,
guy,
what
the guy I'm with, I trust. I trust with my everything.
the thing is
He never
would,
tries to sell me anything.
I would look to someone like Schwab, for example. They create municipal bond ladders. They will actually do it for you. Maybe your Raymond James broker can do it for you. Create a municipal bond ladder, which will give you the same degree of safety that you feel with your cash investments, but it'll get rid of the taxes.
Yeah, that's a big bill, Eugene. So anyway, I mean, maybe that's the starting place too. You should go back to your guy and say, look, can't afford these taxes. We got to figure out how to fix it.
Yeah,
so,
help me out.
You know what? I'll call T. Rowe Price, and I'll get back to you guys on the show another time.
I love it. Thank you.
Eugene.
Thank you for
Appreciate
listening.
it.
Yeah.
Okay.
Take care. 855-935-TALK is our phone number here on the show. I'm Don in Florida. Tom's over there in the little studio with the airplanes in
beautiful Duval, Washington. Yeah, love it here. Yeah. You know, we've got guests visiting from Arizona, and they're sitting at John and Maureen. They're sitting outside right now in their down jackets. it's like in the middle of July.
To them, it feels freezing.
I know. They're like, are you kidding me?
We're getting ready to go to the beach where the feels-like temperature next week is going to be 103.
God help you.
I want to be there. 855-935-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
I got to give T. Rowe Price a little bit of credit because they're one of the less expensive active fund managers in America, but they're not cheap by any stretch of the imagination.
Average expense ratio?
Well, I just looked at their T. Rowe Price Balanced Fund and laid it up against the Vanguard Balanced Index. Vanguard Balanced Index is 7/100ths of 1%.
Yeah, 0.07.
T. Rowe Price Balance
0.007. Yeah,
is 0.6 of 1%.
So 10 times, basically 10 times as much.
9 times, 8 times, yeah, something like that. Yeah,
crazy. No,
and by the way, it's funny when you look at the performance of the two funds. You lay them out on, and we don't believe in using performance as a great indicator, but when you compare them with each other, the T. Rowe Price underperforms the Vanguard Balanced Index by about the expense ratio.
0.5% a
It's
year
about
or so.
0.5%. Yeah, it's really curious.
As one might expect.
Anyway.
And less tax efficient.
Our phone number here on Talking Real Money is 855-935-TALK. Our favorite thing to do, seriously, is answer your questions. So we're so glad when you call us at 855-935-TALK that we hurry right over to your call as soon as we can. And this time we're going down to San Antonio, Texas. And BJ, welcome to the program.
Thanks for taking my call, guys, and thanks for everything you do.
Thank you.
When I was a young soldier many, many years ago, I bought this front-loaded fund. I've had it for many, many years, and I'm wondering if I should keep it or if I should dump it. Or switch it over to something more balanced.
What's the fund?
It's a SMMIX. It's a Invesco fund, actively managed, so it's got a expense ratio of 0.85.
Yeah, the Invesco Summit Fund.
Correct. It's kind of a small fund in reference to holdings, roughly around 79 or 80 holdings.
Yeah. Yeah. And it's let me look at that portfolio. Yeah, 83 basis points. That's a pretty pricey fund.
I think I can see why they call it the Summit, because you're right up there among the highest.
Well, look at that. It looks exactly like an S&P 500 fund.
Minus about 400 stocks, yeah. So
yeah, because, I mean, it's number one holding. Here are its top holdings. Nvidia.
Shocker.
Microsoft.
Really?
Amazon.
Never would have thought.
Meta.
There's somebody
Apple,
really doing their homework. Yeah.
Broadcom.
Okay. Good Lord.
Alphabet, Tesla.
It's what we in the business calling, BJ, a closet index fund that charges you, what can you buy VOO for now? Like 3 basis points or something.
Yeah, I think it's 3 basis points.
You get almost a similar portfolio with greater diversification at, I can't even do the number. 8/10 would
it hurts your
be
brain
10 times. Yeah, it's just a lot less. No, that would not be a fun.
I would probably be bailing on that with a little tax planning, because what it is, it's a classic large cap growth fund. It's just big cap growth stocks, and that's been a great place. I want to emphasize the past tense word I use there. It has been a great place to invest over the past couple of decades. You've done very well with it. Congratulations. But no, it's not a fund we would own long term.
Okay, yeah, that's what I was thinking, maybe to going toward a AVGE or a DFAW.
And
you're talking our language now.
You'd be cutting the expense ratio by at least 2/3 and massively diversifying your portfolio from 70 to thousands.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back to the program. I'm Don. That's Tom. And Tom, a more fair comparison between the Invesco Summit and the Vanguard fund would be VUG, not VOO.
Because
VUG is the growth, large cap
the growth part of the S&P. Sure.
Right.
Yeah.
And what you would get if you were with Vanguard is about 100 more stocks. You'd get a 4 basis point expense ratio versus an 80 basis point expense ratio. You'd get lower volatility, a lower risk of total loss, and get this, a higher return you would have gotten.
And I'm going to add one more. You'd buy the fund and you know what you're going to own every day into the future. With the Invesco, the other fund, that may wake up tomorrow and go, wait, those stocks are way overvalued. You've got to own these. No, you don't want to buy that fund. That's not the direction.
It can be so much simpler, and that's really what our point is. We don't want to go around comparing returns, although we can. What we want to do is look at the logic of the investments, the reasonableness of the investments, the expectation. Do you truly, in your brilliant logical mind, believe that an active manager can beat the market, given that they have to accurately and consistently predict the future over and over again?
Which
That's
we know, looking back, no one's been able to do, basically.
I mean, a few, but the funny thing about all the studies that have been done is all of that outperformance. When a fund group says we outperform the indexes, well, all of the research shows that the vast majority of that outperformance is more attributable to taking additional risk or luck. 855-935-TALK. That's the phone number here. Lakeland, Florida is our next stop, just down the road from my place. Ron, welcome to Talking Real Money.
Thank you guys for taking my call, and I can put a check mark on my bucket list completion. My simple question is to you is, if my wife has ETFs that are doing very well, should I also use those same ETFs in my account, which I'm copying hers, or should I diversify more and go into something else? other ETFs.
Well, you should have an overall plan that says, here's what we want our household asset allocation should be. Mm-hmm. Then it should be, where are those assets held? You've heard us talk about this on the show and the podcast before. For example, in your Roth, you could have more risky things, riskier types of ETFs. In your traditional IRAs, those sorts of places, that's the place to hold your bonds, right? Because the taxation there does not only affects you when you take the money out. And then the taxable account, you're going to have more stocks there. So the short answer is, yeah, you could have overlap, but it'd be better not to have it.
Well, no, see, I disagree. If, let's say, for example, just hypothetically, you have a taxable brokerage account. You have an IRA.
Yep.
You have a 401k. You guys have all three of those accounts. Each of you do. In that case, your portfolio, based on the pre-planning and the strategy that is required to create that tactical plan, you both should have almost identical portfolios in terms of the assets that are being used.
Because there's nothing wrong. I guess if he's asking if there's something wrong with us holding the same ETFs in all those portfolios, the answer is no.
As a matter of fact, it's probably a good idea because you're trying to pick the ones that you think give you the best chance of future success. So they should be very similar between the two portfolios. For example, you could have AVGE and she could have DFAW.
Yeah, just a little diversification. And the only other argument what I would have would be, for example, in my household, my wife has more bonds. She's more risk adverse. I take more risk with my portfolio because I don't mind seeing the ups and downs. That would be the only other reason to adjust things, I guess.
Yeah.
Okay, got it. That makes sense.
Okay. Well, Ron, thanks for kicking the bucket list or whatever it is.
I just checked the box. We talked to Ron in Lakeland, Florida, so I can check that box out. So thank you. That's great.
You know, when you think about it, it actually is kind of the kick the bucket list, isn't it? We're trying to do them before we kick it. Yeah, Ron, thanks. Take care of yourself. 855-935-TALK is our phone number. It is free, it's easy, and it's a good day for a money question, don't you think? It seems to be. Let's go to Lacey, Washington. Jerry, you're up. Welcome to the program.
Hey, thank you, Don and Tom. It's nice to see Tom back putting in his time here since he's been making you work a little harder this summer. And
taking a break from my vacations, as I like to say, Jerry. Yeah, I show up for a couple of days. Check in.
Well, I understand about those being retired, too. We take a few of those when we can, or as often as we can. So my question for you is I have a $2.3 million portfolio. It's divided 70-30 equities and bonds or fixed. And my wife is currently 68. She takes Social Security right now at full retirement, which was $2,400 a month. I have delayed taking mine till 70. And what we've been doing is Roth conversions with a 1.5 million IRA that we're trying to get down on the RMDs. And so my question for you today is, should I continue with the Roth conversions up to 12 or 22% on the 1.5 million, or should I take Social Security now? If I take it now, it's $3,800. If I wait till 70, it's $4,400. So currently, the money that we need to add into our monthly budget, our budget is $7,000, and we need $5,000 that we take out of a brokerage every month to supplement that $7,000 living expenses. So I'm trying to figure out if also on the conversion, if we do that right now, we have a tax decrease in our taxes because we fall under low income, which is neither here nor there, but it saves us $6,000 a year in taxes, which is considerable. And so my big question, I guess, is there merit to continue trying to get that RMD number down for the next 3 years? Is that a good use? Or the opposite is take the money for the next 3 years, like I heard someone on the show do. So I'm just asking for your thoughts on that.
Okay, couple things here. So, yeah, who knew? Who knew? Okay, couple things. On the conversions, do you have the cash to pay the tax for converting money from your traditional to your Roth?
He does have
we do have the cash in a brokerage account
so that's
that we've
one.
been paying out of.
Number two, I want to make sure I heard you correctly. So what you're saying is you're drawing $60,000 a year from your brokerage account instead of taking Social Security. Is that what I heard you saying? To pay the bills, basically?
Correct.
Yeah, that's
Okay,
that's a little bit more of a challenge.
He's in the window though. Because he hasn't taken Social Security yet, he's pulling money out of his brokerage account. Hopefully, he's doing it in a tax efficient manner. Therefore, because you can take out your assets and not pay taxes if you do it right. Therefore, he may be in a temporarily lower bracket, which would make the Roth conversions up to a bracket like 22.
Yeah, I wouldn't go over
sense.
that.
Right,
yeah,
right.
But here's the thing. Here's another one you need to think about now in terms of income is as a couple, you don't want to go above the 150 mark because you won't get the $6K back from the government in terms of the new bill.
Yeah.
Something you need to consider now because that's 12,000 total, I believe, right, for the household. That's a lot of money. So that should factor in. I mean, so you're really a great candidate to have a professional look at. No offense, because we're doing this in the back of the envelope. Sure. Probably needs a little more specifics than that due to your portfolio size, complexity around Social Security. I'd run all those numbers, but sounds like you're pretty thoughtful about them in a way that many people are not. So congratulations for that.
Yeah, you're rich enough that you probably should have a little bit, even if it's just somebody to look it over once or twice, and you just pay them by the hour, because it's going to help manage that tax hit here and down the road and keep your benefits coming in, those other benefits like the $6,000.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
855-935-TALK. That's our phone number. Every Saturday, give us a call between noon and 2 Pacific time as we do a show on Northwest News Radio. And let's head down to the land. Oh, well, never mind.
The land is gone.
It said lost Sherry. That's who I was going to. Sherry.
Yeah, well, I got something I feel
Well, wait, you can
compelled
probably
to mention.
answer Sherry's question.
Oh, which was?
This is actually pretty easy. She was gifted $4 million worth of Microsoft. Should she keep it in Microsoft or Diversify? You can answer this.
Okay. So first of all, you should get, if you inherited it, you get the step up in basis, so it makes it easier to sell.
It says gifted.
And yes, we'd be selling it.
It says gifted.
Yeah, that would be.
Yeah, but because it's a lot of money, like we just said to Jerry, you need somebody to help you plan the sale of this so that it's done in such a way that keeps you from getting killed. Now, to your point, yes, Thomas.
Well, I I'm a reader of LinkedIn. You laugh at me because that's the only social media I do.
I don't read LinkedIn. I don't do any social media anymore at all.
Last night, I hope this is a joke, but Jordan Belfort, the Wolf of Wall Street guy, Stratton Oakmark, he made a post. He said, say what you want about Stratton Oakmark, but we built something no one could ignore. We took kids with no experience, no direction, and turned them into closers. Gross. No, he says closers.
I'm sorry.
So I did. I couldn't help myself. I wrote, congrats on being an amazing thief, cheat, liar while hurting so many people. But there's about 50 people that wrote in support. Oh, that was a great movie, Jordan. You're a really great guy. And look at all the closers you trained. Are we going to congratulate Germany for being a small country that overran all of Europe? I mean, this is outrageous.
Congratulations with the speed at which you took over Europe and killed millions.
Really?
I mean,
this is disgusting.
I don't blame you.
He also said we transformed Wall Street or something.
You made Wall Street even worse than it was.
Yeah, right. That was my take. Yeah, it was bad enough without your help. So
what a
horrible post. Absolute. Yeah,
that alone that should violate his probation.
Well, he has not paid back his fine. He never paid the settlements. He just goes on and on and on. He's doing whatever he likes.
Well, here's the problem, though, and this is an issue that I believe exists across much of the financial industry. Is you have to, I think, to survive in your own little brain, justify your horrible actions. It's like the insurance agents who sell equity indexed annuities. They sell them, they collect 10% commissions, and they do it without any twinge of guilt because they have been convinced or they believe that they are doing what is right for their client when in fact they're doing what is right for them, not their client.
They've overlooked who they're really helping.
We're good at justifying. We really are. We all justify our awful actions. I've done it Tom, I don't think Tom's ever done it. No, he's
Oh God,
never.
yes.
Horrible human
Not
being.
this morning, but other days, yeah.
Not in the
So far
last
today,
hour.
I've been good so far. Yeah, exactly.
Hey, if you want to, outside of the show, if you're calling in the show, the number is 855-935-TALK, and it makes for a fun conversation. But other times, we know you have questions, and so we would encourage you to go to talkingrealmoney.com and ask your questions there. You can speak them or you can type them. But the other cool thing you can do, and we've talked about this a couple of times, you need some help, we've said. Well, here's the thing. We don't just say it, we actually provide it.
Yeah, you can click on Contact an Advisor and again at talkingrealmoney.com, get a look at your portfolio, your plan, and talk to someone.
Meet an advisor. Meet an advisor.
Current on the date recorded.
You find it.
Opinions,
It's on the
estimates, forecasts,
website.
and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor. Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services. Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.